Uh, Wow. And so welcome again. Happy New Year to everyone. This is the start of at least our community impact briefings for the month of January. So welcome and thank you for joining us today. My name is Raquel Reddy. I'm the Managing Director of Community Development for NCST. My colleague is also here, David Hunter, who is our Director of Policy. And obviously our guest is here as well, and that's Michael Fratantoni with the Mortgage Bankers Association, we are delighted to have with lots of good information for everyone. So before I do a formal introduction for Michael, I just want to mention that, as you know, this SIB call is being recorded. We will also be providing a version of the presentation as a takeaway, and we'll send that out via email to everyone. Also wanted to mention just the ability to do some Q&A. Feel free to drop your questions in the Q&A or chat. I will be monitoring that. And we would like, if you could, we'll hold off until the end of the presentation to get started on the questions that you have. But with that, thanks again for being here. I am delighted to present Michael Fratantoni with the Mortgage Bankers Association. And if you've had questions on your mind, just as much as David and I have had about the market and what's going on in the housing and mortgage and interest rate space, you have come to the right event today. Let me introduce Michael, just formally give a little background, and Michael, then I will hand it off to you. Michael Fratantoni is MBA's Mortgage Bankers Association's Chief Economist and Senior Vice President of Research and Industry Technology. And in this role, he is responsible for overseeing MBA's industry surveys and benchmarking studies, economic and mortgage originations forecast, industry and technology efforts, and policy development research for both the single family and commercial multifamily markets. Additionally, Michael's a member of the board of directors for MISMO and the membership committee of MERS. Prior to joining MBA, Michael worked in risk management and was a senior economist and had senior economist roles at Washington Mutual and Fannie Mae. Michael received a PhD in economics from Johns Hopkins University and a Bachelor of Arts in Economics from the College of William and Mary, and has served as an adjunct professor at the University of Washington and Johns Hopkins, George Washington, and Georgetown universities. Michael, thanks so much for joining us. We are really excited to hear a little bit more about what you have to share. I think your presentation is up, so green light, we're all seeing that, and you have the floor. Thanks.
Great, thanks, Raquel. I appreciate the opportunity to talk to your group today. As I think you know, Mortgage Bankers Association and NCST partner in lots of places, including our Consumer Affairs Advisory Council. So again, appreciate the opportunity to be with you today. So my plan is to talk about a few things. One, our macroeconomic outlook, certainly an interesting time to be forecasting the economy and what's going to be happening to rates. Then really dive into what we see is happening in housing markets right now, both with respect to affordability and sort of the pace of activity. And then, as you might expect, I'm going to focus in a bit more on the mortgage side of things, both the level of activity and some of the changes we're seeing about the types of loans that are getting made, and just give you a little bit of an insight into sort of how lenders are thinking about the market today. Let me kick things off. Boy, what a difference a year makes. What this picture is showing is the Fed's own projections about where they thought the Fed funds rate, their primary instrument of monetary policy, was going to be over the course of time. And if you look at that bottom line, that March 21, in early 21, they were expecting to be at zero through 2023. Fast forward to December of 2022, they're now expecting to be at 5% by the end of 2023 for the Fed funds target. A wild difference. Absolutely extraordinary how quickly the Fed changed their stance with respect to monetary policy. You can see also that they do anticipate that 2023 will be the peak for short-term rates, and then they'll start bringing them back to normal, where normal, call it 2.5% to 3%. Now, why did they move so quickly? Why did they change the stance of monetary policy so abruptly and so completely from 0% to almost 5%? Well, it's all about inflation. So we saw in 2022 the highest level of inflation that we've seen since the early 1980s. And whether you look at the headline number, which includes some more volatile components like food and energy, or the core number, any way you look at it, inflation was running much, much faster than we've seen for decades. Really going back 20 years or so, the Fed's had a stated intention of keeping inflation at about 2%. And you can see for much of the teens decade, any deviation from that, you could measure in tenths, right? And so they were essentially hitting that 2% all the time. So to be this far away from the target is really what caused the Fed to act so abruptly. What this chart is also showing, though, is that I think many forecasters and financial markets expect that the tide has turned now, sort of the fever has broken. So whether you look at the year-over-year numbers, the 12-month changes, which are in red, or annualize those last 3 months, inflation is dropping. It seems to be dropping pretty quickly. And there was a number this morning on wholesale inflation, which actually showed a decline in input prices over the course of the last month. So Fed making some substantial progress on getting inflation back down towards the 2% goal. Don't think they're going to get there really until 2024, but making faster progress than anybody would have guessed even as much as a month ago. Now, one way you measure the sort of stance of monetary policy is the extent to which that Fed funds rate, again, we're at about 4.5 right now, I think we're going to go to 5. To what extent is that greater than inflation? So the real Fed funds rate, the inflation-adjusted Fed funds rate, it's tough to measure because you really want to adjust by expected inflation over the next year. And now it's dropping so quickly that we may already be in a place where monetary policy is restrictive. Again, just sort of one more slide in inflation, and a year ago I would have spent about 30 seconds talking about inflation, but it is so central to the outlook right now that it's worth diving a little deeper. You look at some of the components of inflation. So as of the most recent data point, all in inflation, the headline number rising at about 6.5% on a year-over-year basis. The core number, which takes out those more volatile food and energy components, down to 5.7. But an interesting one for this conversation, this audience, one of the components that really has been one of the prime contributors to overall inflation is the cost of shelter. And you can see here the way the Bureau of Labor Statistics measures that for incorporation into the Consumer Price Index. Shelter costs were up 7.5% year on year. Now, I'm going to take you a little bit deeper dive than you might be used to in terms of exactly how these numbers compare to some other numbers that you may be working with. So if I said 7.5% shelter cost inflation 6 months ago, my guess is that many of the folks on this call would have said, well, that's way too low. We know in many markets in the country that rents are going up double digits. And this is probably the second year in a row they were going up double digits. So that was maybe 6 months ago. So that 7.5% would look low. But now the market has certainly turned. We have a lot of multifamily supply coming on. And we've also seen the demand for rental units fall off as more than likely we're in a recession and will likely be here over the next 6 months or so. But the way the BLS measures the shelter cost, it's a in-place rent. So you look at how are rents changing for all rental units across the country. Where most market participants and folks watching the market are looking at asking rents. How are rents changing on that next available unit? The in-place rents are just going to move more slowly, going to be more persistent. For most of the last couple of decades, it really didn't matter for policy considerations, particularly for monetary policy. Now it matters a lot because shelter accounts for about 30% of the entire consumer expenditure bucket. It accounts for about 40% of core CPI. So it is really a driver of overall inflation, and we're not going to see the overall number get back down to 2% until that shelter number turns around. So those are the green bars on this chart. The folks that follow the economy know that the Fed is doing two things at the same time, or at least that's the goal. One is to keep inflation at about 2%, keep prices stable. The other is to aim for maximum employment. So what this chart is showing is in dark blue, average monthly job growth going back to the past 20 years or so. And then in light blue, our forecast of what that job growth is going to average over the next 3 years. And the orange line is looking at the average unemployment rate by year over that same time period. So a couple of things to highlight from this chart. One, if you look at 21 and 22, these are the two fastest job growth years we've had over the past 20 years. 21, it's just a rebound from that colossal drop in jobs we had in 2020. But 22, just a sign of just how strong this job market has become. In the December data, we matched the low for the unemployment rate in more than 50 years at 3.5%, and we averaged 3.7% for all of 2022. As I mentioned, we think the economy is likely at the beginning of a recession now, and we'll see negative or a decline in the size of the economy over the next couple of quarters. And with that, the unemployment rate is likely to rise. We think we'll be above 5% by the end of this year, averaging 4.8% for 2023. And you can see we're going to get there by, we think, losing on average about 25,000 jobs per month, with most of those job losses really accumulating in the first half of the year. 24 and 25 we see as recovery years, unemployment rate come back down again. We are seeing some signs of softening in the job market. Some of that's being reflected in a smaller number of job openings. That's the green line here on the left, a slower pace of hiring. You're also seeing a reduction in the pace of wage growth. So wage growth has been running below that inflation number for a number of months, so making it harder and harder for families to keep up, given that their income is not increasing at the same pace as their outgo. And now we're seeing that wage number come down even further. From the eyes of the Fed, that's positive because it's likely to further reduce inflationary pressures that we're going to see in the year ahead. So households looking at a job market going from unbelievably strong to somewhat weaker. If you remember back in the financial crisis more than a decade ago, unemployment peaked at more than 10%. And I'm suggesting that in this recession, we're going to peak at something just over 5%. But it's still, for those couple of million households, their job situation definitely more precarious. But I think a positive for much of the housing sector is that so many households from a balance sheet perspective are just in phenomenal shape. Now, you've got more than 90% of households with the mortgage with a fixed rate loan, 4% or below. And what this chart is showing, data from the Fed, that if you look at a household's debt service relative to their income, it's extraordinarily low. So many millions of homeowners successfully locked in just very, very low mortgage payments. And that's going to help them sort of weather the storm over the next year or so. Now, one of the really unexpected side effects of the pandemic and the policy response to the pandemic has been an incredible buildup in liquid savings for a lot of households. And this is some charts from Deutsche Bank just sort of estimating, because we are now beginning to see many households pay down some of those, quote, sort of excess savings that they had built up during a time when their income might have kept coming, but when the economy was shut down, they had nothing to spend it on, and we just saw bank deposit balances just go through the roof. But those will probably be run through by the time we get to the end of the year. In the chart on the right showing, as you might fully expect, a lot of those, again, quote, excess saving balances are really towards the top end of the income spectrum, and a lot of low and moderate income households weren't able to build up as much of that buffer and have worked through it more quickly. So, with that quick overview of sort of the macroeconomic environment, where do we think rates are headed from here? Well, I think it's really important to distinguish between short-term rates like the Fed funds rate, and the Fed has a meeting end of this month. We think they'll raise 25 basis points. They might raise another 25 in March. So that gets them up to about that 5% rate that you hear a number of Fed officials talking about. We think they'll hold it there through much of the year until inflation drops back down to 2%. But longer-term rates like 10-year Treasury rates and 30-year mortgage rates, they've already begun dropping. So fall of last year, we got as high as 7.2% for a 30-year mortgage rate. The number re-released this morning for mortgage rates last week were at 6.2%, so a full percentage point down. Now, that's not the 3% rates or the 2 3/4 rates that we had in 2021, but it's a whole lot better than 7. And our expectation is that longer-term rates will continue to drift down through the course of 2023 until we get to somewhere in the neighborhood of 5.5, 5, somewhere about a percentage point lower than we are today. And that's reflecting the Fed beginning to normalize rates, as I suggested, and also just this weaker economy that I've talked about, higher unemployment rate. Another factor contributing to our mortgage rate forecast is just sort of this curiosity we've had the past year, where the difference or the spread between a 30-year mortgage rate and a 10-year Treasury rate has just been unbelievably wide, really reflecting the level of volatility in financial markets and just a lot of uncertainty about where the Fed's headed next. I think as that uncertainty begins to diminish a bit, as the Fed hits the top rate and then begins to communicate about when they might drop rates, this spread will come in. That'll be another factor leading to somewhat lower mortgage rates. Now, I highlighted, how many millions of homeowners have been successful in locking in extraordinarily low mortgage payments at a time of record low mortgage rates. Sort of the flip side of that, from a mortgage perspective, is it would take rates below 3% to really drive a refinance wave again. So at this time in the market, we're seeing just a unbelievably low level of refinance activity, and we have no expectation this is going to pick up much. So the number we highlighted this morning is that refinance application volume is down about 80% compared to where we were last year. So focusing a bit more on the activity with respect to home buying. And so our weekly data, we track the volume of applications for home purchase. And this is one way we show that data. And so each of these lines represents a successive year in terms of volume of purchase activity, and this is in number of units. Now let's draw your attention to 2 of the lines here, or maybe 3. Let's start with that light blue, which is 2020. So you can see the year started off strong, the pandemic hit, lockdowns in effect, huge drop in level of activity. But then in May of 2020, sort of as soon as the gates were opened on those lockdowns, we experienced a housing boom that we hadn't in a very, very long time. And that level of activity in the second half of 2020 really exceeds anything anybody possibly had predicted. 2021, we started the year, 2021 was a solid year in units because of the shortage in inventory on the market. If you look at this in dollars, it's even stronger. Now let's look at 2022, which is black compared to that gray. 2022 started the year pretty strong at a 3% mortgage rate, but by the time we got to late April, early May, we were pushing rates into the 5s and then into the 6s. And then once you got into the 6s, look at that black line, just really took a nosedive as we got into middle of the year last year in 2022. And as we pushed rates further and further up into the 7s, activity really never recovered. And so for the full year, running about 35 to 40% below where we were in 2021. So a pretty bleak picture for the housing market as we finish 2022. But I guess I wanted to sort of distinguish that from our forecast over the next couple of years, which continues to be really very, very favorable with respect to activity in the housing market. And that's really being driven by demographics. So chart on the left is just looking at the distribution by age of the U.S. population. There are currently about 50 million people between the ages of 28 and 38, so these are the millennials. And it's just leading to an incredibly rapid pace of household formation, about 1.5 million households being formed per year, whereas in the time period from early 2000s to 2015 or so, we were averaging about 1.0 million per year. So a big increase in household formation, a lot of renters, a lot of home buyers. And one thing I'd really highlight is this chart on the right. Look at the gray line, which is the homeownership rate for those under 35, compared to the yellow, which is a 35 to 44. And what this really says is these are sort of the age ranges where a lot of change happens, where folks are going to move to home ownership. This is often the age range where that happens, this 28 to 38 range. So we're expecting very, very strong housing demand, both in the rental and the for sale markets over the next several years, given this bulge in the millennial group hitting peak first-time homebuyer ages. Now, longer term, it's a bit of a different story. You've probably seen some of the press over the past couple of weeks looking at really the very, very sharp drop in births and the very, very low change in population in the U.S. the last couple of years, and that's coming from fewer births, more deaths related to the pandemic, and lower rates of immigration. All of that saying, once we get beyond sort of 2025, 2026, you have two factors at play. One, the smaller Gen Z generation coming into peak first-time homebuyer ages, and now you're going to have a really pretty rapid and sudden stop to population growth. So beyond 25, 26 might be a different story, but for now, we really are going to have more demand than we can handle, particularly given the lack of supply in the market. And this is a chart that one of my colleagues put together using Census Bureau data, just tracking the total number of units built by decade across all types of housing units: single-family detached, single-family attached, small multifamily, large multifamily, manufactured housing, or mobile homes. And look at that bar for 2010 to 2019. The U.S. built fewer units across all types of housing than at any time since the 1940s. And then the 2020s, not off to a good start. This is just assuming we continue at the same rate for these first couple of years of this decade. Pandemic obviously made it even worse than we had last decade. So strong demand coming from the demographics in a really structurally underbuilt market. Not surprising that if you then throw on also a doubling of mortgage rates, that affordability looks particularly bad. And here on the left, we're looking at median mortgage payments and the 25th percentile mortgage payments and median asking rents. And the story in 21 and 22 were sharp increases in cost of housing, cost of shelter, whether you owned or whether you rented. The chart on the right is just comparing those two. And what that's saying is that if you look at mortgage payments relative to rents, they really don't look out of line compared to what we've seen historically. But if you look at either relative to incomes, it's an affordability challenge, particularly for younger and lower and moderate income households. Now, I talked about sort of the structural undersupply, but in the face of a recession and in the face of this spike in mortgage rates, not surprising that builders have pulled back, both in terms of permitting activity and housing starts. And we've actually seen a pretty sharp drop in the pace of new home sales. There was a more positive number out this morning, the Builder Sentiment Index that NAHB puts out, actually showing perhaps a turn level of activity, but level of activity still extraordinarily low. So our forecast for home sales, a little bit different depending on whether you look at the new home market or the existing home market. In the new home market, because of the challenges builders are seeing, we expect them to give a little bit more on price to keep transaction volume going up so they're not saddled with a number of, an excess inventory of completed homes. So on the new home market, deeper price drop, transactions don't fall quite as much. Existing home market, we see the opposite. We see current owners delisting properties. If you're not in a place where you have to sell right now as an existing owner, I think they're not going to sell. I think they're going to wait for a sign of a turn in the market. So we're forecasting a steeper drop in the number of transactions on the existing side, but much less of a drop in terms of home prices, because again, on the supply side, current owners, if they don't have to sell, they're not going to sell. What does that all mean for our forecast for home prices? This is the history and our forecast for the national FHFA index. So you can see there in 2021 at the peak, national home prices growing at almost 19% year on year. That's begun to slow, but it's still growing sort of 8 to 9%. We think that number will turn to sort of a small negative by the end of this year. But really the right way to think about this is we think for 23 and 24, on a national basis, home prices essentially going to be flat. That national number being close to zero, though, probably means that about a third of the markets in the country are going to show, some noticeable declines, and we're certainly seeing that in the West Coast markets, some of the mountain states, where you're already seeing sort of high single-digit declines on a year-over-year basis, and we're probably going to see more of that because that's where prices have gotten a bit detached from fundamentals in some of those markets. Last couple of thoughts that I definitely want to open it up for questions. One thing that we track is what's happening in terms of credit availability. So we're looking at the terms on the mortgages that are available in the market. We've actually seen tightening over the last year. That big jump that you see in that 2005, 2006, for anyone in the industry or watching the industry at the time, that was a time when credit really sort of went wild. Those were the no-doc and all types of subprime products that are really not in the market anymore. And you can see post-Great Financial Crisis on, credit has been really much more disciplined. But in the last year, given sort of the travails in the housing market and really the disappearance of the refinance market, we've seen credit terms really very tight. One thing we're seeing on the right is that the share of loans that are adjustable is going up. What that blue outline is telling you is that the absolute number of adjustable rate loans really has not moved very much. It's just that the fixed rate loans have fallen away, and those that remain are more likely to be ARMs than fixed. From a lender perspective, this picture is really important, looking at what's happened to origination volume for new mortgages over this 20-year time period. So 2020 and 2021, the two biggest volume years ever, north of $4 trillion per year. 2022, that dropped by about 50% to $2.2 trillion, and we're forecasting another 15% decline for 2023. But we're looking for a bit of a rebound as we get into 24 and 25, and we get past that low point in terms of home sales volumes. Last couple of thoughts, and then I'll open it up for questions. We're obviously also watching very closely the level of delinquencies and foreclosures in the market. So at least as of the third quarter of 2022, that green line there showing across the entire market, 3.45% of loans delinquent. That is the lowest delinquency rate we've seen in the more than 40-year history of our survey. So unemployment rate at 3.5%, driving a lot of that, and the fact that so many homeowners have so much equity, if they were to become delinquent, they were able to sell their home pretty quickly. On the foreclosure side, we had the moratoria in place during the pandemic. That's been lifted, but we're still seeing very, very low levels of foreclosures. Again, given the fact that if you have a homeowner that needs to sell, they've been able to sell relatively quickly given the lack of inventory in the market. And then my final slide, we've also, over the past couple of years, been closely tracking the share of loans in forbearance. Remember, at the onset of the pandemic and then passage of the CARES Act, widespread forbearance was an option, a bridge for many homeowners to get through the crisis. At one point, 8.5% of all mortgages in the country were in forbearance. We're now down to 0.7%. But just one thing I would highlight here, the blue line here looking at Ginnie Mae loans. So these are loans securitized in Ginnie Mae MBS, so loans insured by FHA, VA, or USDA. That share in forbearance has actually started to creep up again the past couple of months. And that FHA borrower often sort of a bit more sensitive to any changes in the underlying environment. So some of the weakening in the job market that I mentioned, some of the challenges with food prices going up 10% per year, and other necessities of life becoming increasingly costly, all of that leading to somewhat higher delinquency and forbearance rates in that Ginnie Mae sector of the mortgage market. So Raquel, let me stop there. As you said, we'll be able to send out a PDF of these slides to the group. Here's my contact info. Happy to take any questions if they come up to you after this conversation, but for now, I wanted to open up and see if anybody had any questions at this point.
Yes, and thanks so much again, Michael. This has been incredible information. I can see in the chat we've got a couple questions, so let's start there. And for folks who are still joined, please feel free to add any other questions that you have. So this question comes from Eric Schertzing, and Eric, I might have to have you clarify some of this. It says the great household numbers. How much is this the better off being much better, and the worse off really hurting? That's one question from Eric. I don't know if you want to go ahead and respond. Oh, sorry.
Yeah, so I think that was probably with respect to sort of that excess savings that came out of the pandemic time period. And I did share that one chart looking by income quartile. And yeah, absolutely, a lot of the excess saving is in sort of the top 2 quartiles by income. And we've seen for low and moderate income families that they burn through any savings they had much more quickly. And we're also seeing revolving credit balances increase pretty sharply too. And I think that again reflects sort of a greater sensitivity to the increase in food prices, the spike in energy prices, and then certainly, as I mentioned, the lack of affordability, whether you're a renter or an owner in this kind of a market.
Thank you. Thank you, Michael. We've got another question here. Let me just pull it up. This is from Joe Hansen. So and I had this question too. In what industries is the most softening in the job market expected to occur? I mean, just today we heard about 10,000 layoffs predicted from Microsoft. Do you have any insight on that question and industry?
Yeah, great question. So yeah, we're obviously seeing these announcements from the tech sector who, in many cases, what they've said is they overexpanded during the pandemic, perhaps thinking that some of the trends we saw towards e-commerce during the pandemic were going to continue to grow at that rate forever, and instead we came to sort of a sudden stop as things opened up again and people wanted to breathe some fresh air. So certainly that sector is one. I'd point to my own, right? We're forecasting that about 1/3 of mortgage industry employment that is going to disappear over the course of this downturn, and have already seen quite a bit of that. Also in the financial sector, seeing other layoffs, Wall Street, elsewhere. Beyond that, we are seeing very, very sharp declines in the pace of manufacturing, really across the entire economy, and also in global trade. So, any worker connected to either sort of manufacturing or the ports, sort of warehousing, that's a potential source of additional job losses there.
Thank you for that. I got a couple more questions coming in. So another one from Eric here. See skew. Okay, so there's a skewed chart. How well do we really feel the skew? I'm not sure what slide number you're referring to there, Eric, but I'll just go ahead and read the question. How well do we really feel the skew? This is an unprecedented time, and the news reports on average miss the skew. Okay.
Yeah.
Eric, if you can.
So yeah. I would just say that I totally understand the context of the question, that oftentimes we're reporting averages and aggregates because that's the information that we have, and we don't on a high frequency have the same information about the distribution of sort of where along sort of the income scale people are being most affected. But I think it is a pretty safe assumption to think that that there's going to be the largest impact of this economic downturn at low and moderate income levels.
Thank you again, Michael. We've got another question that has come in. Why do you think the Fed's inflation forecasts were so wrong? Is this just the Ukraine effect?
That is a great question. Please ask your next Fed official when you see them. But it's tough, I said, right? So, for decades, the Fed was very, very sort of paranoid and worried that inflation was going to get out of control anytime the economy heated up, and it never did. To the point that in 2021, they released a whole new sort of philosophy around monetary policy where Chair Powell was saying, look, we're going to be more cautious about raising rates because we don't want to artificially harm a job market that finally is reaching people that never really seem to get on their feet. So it was very conscious on their part to underreact to any initial sign of inflation. But I think where people might fault them is they could have been slow in sort of middle of 21 and late 21 to react. By the time you got to 2022, it was pretty clear to folks that it was time to move, and by waiting so long, it allowed inflation to get much more of a foothold than anybody would have thought. But I think it really was the miss was because of 40 years of being wrong on the other side, and sort of led to some changed behavior.
Thank you, Michael. I think there was just a comment about the Microsoft. Thank you for that. There was an additional comment about the Microsoft layoffs announced today. It represents about 5%, a 5% layoff. I had a couple questions that I wanted to ask as well, and anyone else, please continue to ask your questions. We will keep Michael as long as we can to just help us with some of these. But one of the things you mentioned was, again, seeing originations take that dip down. I've also been noticing, major financial institutions, talking about either consolidating or selling off their servicing arms. Is that more directly as a result of the forecast of originations taking that dip, or are there other reasons behind that?
Yeah, no, I think it's a direct connection that on the origination side, you've seen lenders of all shapes and sizes trim their staffing in response to ours, others, their own forecasts of where origination is going to be heading the next couple of years. And then on the servicing side, we had this one particular announcement from Wells Fargo, and I think that was just sort of a change in course to, for a long time, they had really been the national leader in terms of both origination and servicing, and I think it's a very much a conscious decision to reduce the scope of mortgage within their organization.
Thank you. One more of my questions for you in terms of that, the housing supply, and at least from the property type perspective that you provided, Michael. And I don't know if you have any detail on this, but I was sort of interested in finding out, when you talk about sort of those millennials being a part of the market that we should see some uptick in home buying, are there changes to how they're looking at of how home buying, innovation, maybe more manufactured housing, the typical single family, smaller homes? Are you noticing any differences or have any intel on the difference in the property type itself?
Boy, that is a great question. I would just say it is more muddled now than ever, right? And it's all due to the pandemic, right? Because pandemic started, people left the cities, and this is after decades of the city is back and everybody wants urban living, or at least, moderate to higher income young people left the cities, or at least didn't arrive in the cities. Towards late 21, 22, that completely reversed, and you saw the rental market going through the roof again. The other one that is just, again, you get any two people together, you talk about return to office and work from home, and what does it mean? Are people going back hybrid? Are they staying remote? I don't think we've come close to figuring that out yet. And that's the piece that needs to get locked in first, because if people know they're going to be going to the office 5 days a week, I think that'll lead to certain housing decisions. If they're going to be remote 100% of the time, that'll lead to other housing decisions. And I think we're in this mixed place right now where people don't really know which end is up, whether you're a builder or a buyer. It is really confusing. And I think the only folks that have a clear sign right now is those that own or operate office buildings. They're really worried because they still are very low vacancy rate. Very low occupancy rate, excuse me.
Yes, thank you. Thanks so much. We do not have any other questions in the queue, although I have one more if we have time. But David has a question.
I,
And-
I do.
and Go ahead, David.
Thanks, Raquel. Michael, can you talk at all? Are you tracking trends related to investors, corporate investors, or others in the single-family market, impact on pricing and housing supply? And to the extent that you're following this on foreclosures as well, like REO purchases.
Yeah, no, good question. Certainly get a lot of interest there. So investor share across the market is down a bit. I think one reason for that is investors you might sort of present as having a quote cash offer, but they really are just borrowing elsewhere. They may not be borrowing on a property by property basis. They're borrowing at a bigger scale, and that's probably tied to a short-term interest rate, not a long-term interest rate. So they're facing higher financing costs right now. So you're seeing particularly some of the large investors back away a little bit. But I know that so much of the institutional investor activity has been concentrated in just a couple of markets and a couple of neighborhoods within markets. So it's having an immense impact in a couple of different places, but big scale, not the same kind of impact. One thing I am hearing from folks that are involved in the foreclosure auction process or REO sale process is that at the foreclosure auction, oftentimes third-party bidders are outbidding the lender or the servicer. So again, just given the lack of inventory in the market, they're looking for properties. So that's where I see actually investors may play a larger role as at those foreclosure auctions or at an REO sale. But again, distress is so low in the market. Again, having lived through the great financial crisis, it's nothing like that. So not a lot of opportunities for them there, but I think they are grabbing them when they can.
Thank you.
Great. Thanks again, Michael. It's just been a pleasure having you join us today and present on your forecast, as well as just kind of walking us through, some of the reactions to these questions as well. At this time, and we're going to probably take a pause here and welcome David Hunter from our team to talk to us a little bit about any regulatory and legislative policy updates, if you will. And with that, David, I'll go ahead and give you the floor.
Thanks, Raquel. Great. Hi, everybody. Nice to see you virtually again. With 118th Congress now in place and control of the legislative branch split, Democrats in the Senate and Republicans in the House, both with very thin margins, the expectations for advancing any kind of major housing legislation or for other domestic policy priorities over the next 2 years is very tempered, I would say. And I think I've said this on previous calls. We do continue to view the kind of best opportunities for affordable housing, advancing affordable housing and home ownership priorities as being on the administration or regulatory side. And I'll highlight a few of our recent activities on that side. In a minute, I just wanted to say that on the legislative side, NCST continues to focus on maintaining and building bipartisan support for the Neighborhood Homes Investment Act, which would provide or create a federal tax credit to attract private investment for building and rehabilitating owner-occupied properties, and creating a pathway to neighborhood stability through sustainable home ownership. So the Neighborhood Homes Investment Act, it has a strong baseline of support coming into 2023. In the 118th Congress, Senator Ben Cardin from Maryland will continue to serve as the Democratic sponsor of the Senate bill, which we expect to be introduced sometime towards the end of this month. And then on the House side, Republican Representative Mike Kelly, and who's from Northwest Pennsylvania, Erie, the Erie area is in his district, and Representative Brian Higgins from Buffalo will again sponsor House legislation, just in different, one in the majority, one in the minority, flipped around now from the last Congress. So stay tuned for updates and outreach. Once both bills have been reintroduced, we'll continue to do outreach to build co-sponsorships again, because we do start at zero. As you know, in the new Congress, the legislation has to be reintroduced. We have to regain all of those co-sponsors and add new. On the administration side, we have a robust agenda, and we're going to talk about that more comprehensively on the February call. I just wanted to highlight two requests that we have pending with Treasury, and for which we've gotten some administrative. Well, both of these would fit and support the administration's goals as expressed in the Housing Supply Action Plan, towards creating or preserving at least 100,000 homeownership opportunities, over 3 years. And one is the Homeownership Finance Fund proposal, which would create a dedicated source of funding for homeownership projects within the CDFI fund's financial assistance program. And then also at Treasury, the Capital Magnet Fund program, and a request that we submitted for either a waiver or an elimination of the home price cap, which applies to the Capital Magnet Fund program, but it was imported from the home program. So it's not statutory in Capital Magnet Fund, and we believe that Treasury has the ability to waive or eliminate, to really take action on both of those in certain ways that would not require congressional authorization or new authorization. And then on the housing preservation side, I just wanted to mention that we are working with HUD to increase opportunities for NCST buyers to acquire foreclosed, formerly FHA insured single-family homes. That's specifically around the claims without conveyance of title channel, and which is its own little world that's become kind of a major mechanism by which servicers dispose of formerly FHA insured properties instead of actually conveying title to HUD. And then also on preservation, we and we'll share a link to this and to some other documents. We just joined a broad group of nonprofit and industry stakeholders on a comment letter this week for Veterans Affairs in support of expanding loss mitigation options for veteran households that are at risk of foreclosure. And I think I said this before, we'll share more about our broader agenda for 2023 in February on the February call. And feel free to throw any questions my way, or now or later.
And David, I did put in the links to all three of those items that you just discussed too. So that's out there for everybody to access as well.
Thanks, Raquel.
All right. Let's just see if there are any other questions. We have a few minutes left. And please feel free to share anything new that's happening either in your market or in terms of your programs. We'd love to hear from you as well. And then obviously any follow-up questions for David. All right, as we're waiting on that, and David gave a little bit of a giveaway for next month's February Community Impact Briefing. So we're going to do a much bigger policy roundup with some of our partners for next month. So we hope you'll join us then, and more information will be sent out for that sub call as well. I call it sub, Community Impact Briefing.
Sorry for the spoiler there.
No, that's okay. It's advance notice.
Are there regulatory changes on the horizon for the ones that increase costs, such as environmental review? Yeah, nothing specific that I'm aware of, Vanessa. Or if you're thinking about a particular program, that'd be helpful, and be glad to follow up with you on that too.
We've got a question in the chat, David. This is a question that just came in. Anything to say about ARPA spending, housing opportunities for 2024 as funds need to be obligated?
So nothing specifically, but I'd be glad to share some as follow-up, some links to information about that. I mean, Treasury has worked to create more flexibilities in the use of those funds. Not sure what, well, I wouldn't know even if you said what municipality or state, but I'll be glad to share some links.
Yeah, thank you, David. I know in different parts of the country, I sit here in Florida, and some of those ARPA funds are going towards hurricane recovery efforts. In other places, it's going towards down payment assistance and also acquisition rehab. So it just depends on, again, what state you're in. So
thanks, Eric.
Thank you for those links, David.
Yes, and Vanessa, you followed up with the home program is difficult to administer due to regulatory requirements.
Oh,
yes, okay, we'll circle back.
And that's a great, just also segue for those of you. Again, we're all in this industry together. If there are things that you see that we need to be, you feel that NCST should be more involved with. Please let us know. We're here to help advocate on behalf of our developer partners and affordable home ownership developers. All right. Well, David, I don't see any other questions, but maybe Nia, it's the 3 times the charm sort of thing that we'll see some action on Nia. It's just such an important part of legislation. And the equity that it could bring to the single family development space. So we'll continue to monitor that, as you said, and keep folks apprised of any updates there. We're just a few minutes ahead of the close of our typical SIB calls. I just want to say thank you for joining today. Michael, thank you for your presentation. It has been a delight, and we'll look forward to seeing you next month. So look out for that invitation. And please reach out to David, myself, anyone else here at NCST if you have any questions or ideas. Otherwise, we'll be sending out some summary information on this call the next day or so. Thank you all, and have a great rest of your week.
Thanks, everyone.
Thanks. Bye-bye.